All right, let's get right into it. We're not going to talk about get-rich-quick schemes or the latest investment craze. This is about the fundamental blueprint for building wealth, the timeless rules that work, especially when you're starting out in your 20s. To really get why your 20s are so important, it all starts with this number, $88. That's what a single dollar invested today could be worth by the time you retire, just based on average market growth. So think about it. Every dollar you waste isn't just a dollar gone. It's like taking $88 from your future self. The stakes are just incredibly high from the very beginning. And this is exactly why your 20s are this unique window of opportunity. It's really the only point in your life where you have this perfect storm of a long-time horizon for growth, your highest potential to increase your earnings, and the quiet, powerful force of compounding just starting to get to work. So our first stop is the biggest hurdle that most people face, and it's probably not what you think. It isn't a bad economy or a low starting salary. It's your own psychology. Before you can ever master the math of money, you have to get a handle on your own mind and the beliefs you hold about wealth. This brings us to a concept called money scripts. You can think of these as the operating system that's just running silently in the background of your mind. For example, if you grew up hearing things like money is the root of all evil, you might subconsciously find ways to get rid of it later in life, basically sabotaging your own success without even knowing why. And this image here really shows the fundamental mindset shift you have to make. It's about moving from an external locus of control, where you blame the system or outside forces, to an internal one, where you realize your decisions are what truly shape your outcomes. It's not about pretending problems don't exist, it's about taking back your own power to act. That's really the foundation of financial freedom. Of course, one of the biggest psychological traps out there, especially with social media, is envy. It's so easy to see people who look rich, with the fancy cars and exotic trips, but that's just spending. Being rich is something different. It's about owning assets that grow for you. And as Charlie Munger said, envy is a pointless game. It's the only sin that doesn't even offer any fun in return. So if willpower and psychology are so tricky, how do you beat them? Well, you build a system. This is the pay yourself first method. You set up your finances on autopilot to make your long-term goals the top priority. First, money goes into retirement accounts like a 401k. Then you attack high-interest debt. After that, you fund other investments. Whatever is left over goes into your checking account for guilt-free spending. You're making smart choices the default.
Okay, moving on to part 2. Now that we've dealt with the psychology, you could call it the software, we can focus on the hardware. This is about the simple, powerful math, the actual physics of how money grows.
You've probably heard this famous line from Munger. It's not just a tough love quote, it's a mathematical fact. In the beginning, your savings rate is doing all the work. It feels like a grind. But once you cross that $100,000 mark, something magical starts to happen. Your money starts working just as hard as you do. The wealth engine really starts to fire up. And here's the simple math that powers that engine. The rule of 72. If your investments earn an average of 10% a year, they'll double about every 7.2 years. This little formula shows you the incredible cost of waiting. If you miss that first doubling period in your 20s, you don't just lose out once. You lose out on the biggest, most powerful doubling that happens at the very end.
This example just makes it crystal clear. Take a look at Erica. She invests for just 10 years, from age 20 to 30, and then stops completely. Now look at Larry. He starts at 30 and invests for 35 straight years, putting in almost 4 times as much money. But Erica still ends up with more. This is powerful proof that when you start investing is so much more important than how much you invest.
Okay, so you're sold on investing. But then this question hits, and for so many people, it leads to paralysis. The financial world seems so complex. How on earth are you supposed to find those winning stocks out of thousands of options? What if the answer isn't complex at all?
And this is the game-changing idea from John Bogle, the guy who founded Vanguard. The research is overwhelming. The vast majority of professional fund managers fail to beat the market average over the long run. So why would you play a game that you're statistically destined to lose? Instead of trying to find the one winning needle, Bogle's advice was simple. Just buy the whole haystack.
And the S&P 500 index fund is that ultimate haystack. Its true genius is its self-cleansing system. Companies that start to fail are automatically dropped, and the new, innovative winners are added. You're not just betting on 500 individual companies, you're betting on the overall long-term growth of the economy. And historically, that has been a very, very good bet. All right, let's head into our final section. We've built the engine, now we have to talk about how to protect it.
This is about building a financial life that can not only grow, but can also handle the inevitable bumps and shocks that will come along the way.
Your first line of defense is an emergency fund. Now, it is crucial to understand that this is not an investment, it is insurance. Its real purpose isn't to earn interest, its purpose is to give you psychological stability. It's the cushion that keeps you from panic selling your real investments when times get tough.
Next up is diversification. The legendary investor Ray Dalio calls this the holy grail of investing. By owning a mix of assets that don't always move in the same direction, things like stocks and bonds, you can lower your overall risk without giving up too much of your potential return. It's basically making sure that one storm can't sink your whole ship. A huge piece of playing the long game is changing how you think about market crashes. For a young person who is going to be a net buyer of assets for decades, a bear market isn't a crisis, it's a sale. You get the chance to buy shares of great companies at a discount. History shows us these downturns are normal, they're temporary, and every single one so far has been followed by a new market high. Now, with all this talk about stocks and bonds, we can't forget about your single greatest asset, your ability to earn money. Warren Buffett always says the best investment is in yourself. This number shows why. A $1,000 course that helps you get a $5,000 raise gives you a 500% annual return. You're just not going to find that in the stock market.
And finally, we have to talk about debt, because it's a tool, and a very powerful one. Good debt helps you buy things that can grow in value or increase your income, like a sensible home mortgage or a student loan for a valuable degree. Bad debt is the opposite. It just pays for a lifestyle you can't really afford, and its high interest rates are like compound interest working in reverse, actively destroying your wealth.
So when you bring it all together, the main idea is this. Building wealth has very little to do with being a genius or getting lucky. It's really about discipline. It's about consistently applying a few simple, powerful rules over a long period of time. The path is actually pretty boring, which is why so few people stick with it. But for those who do, the outcome is almost a mathematical certainty. And that really brings us to the end. You've heard that old saying, the best time to plant a tree was 20 years ago? None of us can change that. But the power to completely change your financial future isn't in the past. It's in your very next paycheck and the decision you make with it. The second best time to start is right now.